Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about another market breadth indicator turning bearish this week, what that means about a downside potential move for the S&P 500. So market breadth is one of the key parts of my technical toolkit. Really helps you understand what's called participation. You have the major indexes like the S&P 500 and the Nasdaq, and we analyze the price movements of those indexes very closely. But what you have to remember is that the S&P 500, of course, is made up of 500 individual companies or individual stocks, and the movements in those stocks are really the story. Now, they aggregate up to the S&P 500 or the Nasdaq's movements, but a lot of times there can be a bit of a disconnect between the major benchmarks and what they're doing and a lot of the stocks that comprise those benchmarks. And that has to do with how the benchmarks are weighted. Our benchmarks are very top heavy, meaning big names like Microsoft, Apple, Amazon, two of which reported earnings this week with some significant moves right afterwards, have an outsized impact on the S&P and the Nasdaq. So by looking at market breadth indicators, we can understand more about all the other companies and what they might be doing. A lot of times it can give us a good early warning sign that things may be rotating. Before we get to the charts, by the way, if you like this sort of thinking about technical analysis, behavioral finance, and investor psychology, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below. What is your target for the S&P 500 if we do get a pullback here? Give me a comment, let me know. Now here we're looking at the S&P 500. We're going to start with advanced decline data, and this is really the foundation of the breadth indicator that we're going to talk about today. Now every day you can derive what's called the advancers versus decliners, or the advanced decline number. And that's literally the number of stocks that closed up on the day minus the number of stocks that closed down on the day. So if that number is a net positive, that means more stocks up than down through the course of the day, and negative would be the opposite, more down than up. Now, that gives you a little bit of information about a particular trading day, but how do you understand the breadth over time? What we do here is we call it's called the cumulative advanced decline line. So here we're looking at the S&P 500, and below there is the cumulative advanced decline line for the New York Stock Exchange. So what does that mean? Every day you look at the entire New York Stock Exchange, how many stocks closed up, how many stocks closed down. That gives you a net number of advancers versus decliners. You add a running total of those numbers over time, and you get a cumulative advanced decline line. So what tends to happen is when a market is going higher, when the benchmark's going higher, the advanced decline line tends to go up, because in an up phase, even though you'll have some down days, the up days tend to be stronger, and that's part of the dynamic of a market in a bullish phase. In a downtrend, when the market's going lower, like you can see here last August, September into the October low, prices going lower, the advanced decline line going down as well. And again, that makes sense, right? When the market's going lower over time, there's more likely stronger down days than stronger up days. And that's just kind of a logical progression of how things start to change. Interesting things can happen at the end of the move, and if you go back to 2020 and the peak there, you'll find a huge bearish divergence. The end of 2021 as well, where prices going higher and the breadth data was actually sloping downwards, showing you there are actually a lot more down days than you might expect at the top. Now we haven't gotten that recently. We haven't gotten any sort of divergence yet. So overall, the broad advanced decline data is basically pretty supportive here of a long-term uptrend for now. And what I mean is the price is going higher. The advanced decline line for the New York Stock Exchange is trending up. The advanced decline line for the S&P 500 is sloping up as well. So that's kind of telling you that the conditions are pretty good. But here's the thing, that advanced decline data is still sort of a very simple aggregation of advanced decline data. What can we do to make it a little more meaningful to understand shifts in momentum? This is going to get to the key chart we'll talk about today, which is called the McClellan Oscillator. Now, Sherman and Mary McClellan were market strategists and did an incredible job of adding to the technical toolkit years ago. And one of the things they created was what's called the McClellan Oscillator. What this basically does is it takes the raw advanced decline line that I just showed you, smooths it out with some exponential moving averages. So you're looking, instead of at the raw data, you're looking at the trend in that data over time. And the McClellan Oscillator is basically the spread between two of those exponential averages of the advanced decline data. It turns basically that trend of that trending cumulative line into more of an oscillator. So it's kind of like looking at an RSI for the markets. It's a measure of the momentum behind the market breadth, if that makes sense. So here we're looking at the McClellan Oscillator at the top half, and at the bottom half I just have the S&P 500 for reference. Now what I'm doing is I'm showing, and I've color-coded my chart. I've basically made the chart red if the McClellan Oscillator is below zero, and I've made it green if the McClellan Oscillator is above zero. A couple times you have these one-day sort of hiccup moves. I ignore those. So if you only have one day in the other side, I skip that one. I keep it with the initial shading, assuming you need a bit of a follow-through, right? You need multiple days above or below the zero line to validate a change in trend. So what happens here, if you look at the green shaded areas, so again, that's anytime the McClellan Oscillator is above zero, and then look at the price action in the bottom. You can see that the green shaded areas are basically those nice impulse moves, nice upward moves over the last 16 months or so. And that's within the bull phase of 2023, but also the bearish phase of 2022. So whether or not the broader market trend is positive or negative, this is a really fantastic indicator for recognizing short-term upswings and downswings, or up thrusts and pullbacks, regardless of the broader market trend. So in 2022, when the broader trend was down, you still had sort of these counter trend rallies, and the McClellan Oscillator going above zero is a great way to identify some of those tradable moves back to the upside. In 2023, really starting in the October low, you can see that the market bottomed out a second week in October. From there, these green shaded areas were those impulse moves, or the big moves pushing the market higher. Now let's look at the red shaded areas, and you can see that in 2022, a bearish year, you can see that the red shaded areas were those big thrusts when the S&P was making a new low for the year, here in May, here in June, again here in September and October. But even after the October low, you can see that tradable pullbacks, or actionable pullbacks as I like to call them, in December, in February, and March, and then in May, all were triggered. Now, the May one was a little different. What you have to remember is in a bullish phase, the market can correct in two ways: in price or in time, and honestly in both, right? A third option, which would be both price and time, a longer protracted decline. February, March is what you'd call a price correction, right? Price is moving higher. All of a sudden, the price pulls back. It's about a 6-week move from the February peak to the March low before the uptrend was resumed. And again, about a week or two after that short-term bottom, the McClellan Oscillator went back to green, suggesting the trend was positive. April into May was more of a time correction, right? It wasn't that the price was going down a lot. It's just that we stopped going up. And the up thrust from March into April was sort of a sideways move. So McClellan Oscillator can capture that because, again, the reason why a benchmark sort of stabilizes is because some of the individual stocks are pulling back, and that is outweighing some of the stocks that are still going higher, most likely. And so that nets into a sort of a sideways move. Once again, this week, we have had the McClellan Oscillator rotate back below zero. It's now been there for a couple days, and I would say this is most likely a confirmed indication that we're in a pullback phase. Now, what's interesting is this is happening in a week with all sorts of different catalysts. We had the Fitch downgrade of the U.S., big earnings from stocks like Apple and Amazon, some of those bullish, some of those not so bullish. At the end of the day, McClellan Oscillator doesn't really care about all of those drivers of stock prices. It's focusing on the price action itself. And when the McClellan Oscillator this week has gone from being above zero for the last 5 weeks to back below zero, it's starting to indicate that the conditions going forward here for the next couple weeks in August, much more similar to pullback phases in the S&P 500 as opposed to continued incline or continued increase in the S&P. What do you think about this read on the McClellan Oscillator? Does it convince you that we're in a pullback phase? Yes or no? Tell you what, drop me a comment. Tell me whether you think we're in a pullback phase, and if so, what's your downside objective for the S&P 500? I'll follow up with a video with my own reading on the S&P and a potential downside target if we do get a pullback going into next week. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you soon.